So hello everybody, once again, here is the chapter 7 slides, and I'll be going through those with a review. Okay, so we're going to talk about the types and costs of financial capital. That's what we talked about. All right, so we're going to, we went over characteristics of financial markets and the weighted average cost of capital, and we'll go over that stuff here, okay? Investment risk. All right, whoops, sorry about that. So we talked about implicit versus explicit financial capital costs. Implicit, okay, is basically, explicit is right there. You've seen the historical numbers, and you've seen the debt. You get the interest, and you get the dividends, right? It's very explicit. All right, so this is implicit. No provision is made to record the less tangible expenses of equity capital, required capital gains to complement the dividends. We don't know if that's going to come. It's just implied, right, implicitly, that we're going to get capital gains. We hope, if the market does well, right? So just know the difference between these two terms. Implicit, this is explicit up here, right? Explicit, and this is implicit. All right, so there's different types of financial markets, and you should know that you should put each of these with their words. So the public markets, markets for the creation, sale, and trade of liquid securities, and it's standardized. These are standardized markets. Private financial markets are negotiated, and they're not standardized, and you may have private investors. And you see it says less standardized, right, for private financial markets. All right, everyone should know what interest rates are, which is the price paid to borrow funds. So, all right, so these are the two, and there's default risk, is risk that a borrower will not pay the right. So you know how people default on loans or mortgages, right? So just know what the terms that go with these words here. All right, so the nominal interest rate is, you've probably seen this in 330, is the observed or stated rate when you go to the bank for a loan or to put money for a savings account. They're going to tell you the nominal interest rate. And the real rate doesn't take into account inflation or any other type of risk. It's basically the rate that the government charges without looking at anything else. And the interest rate, the risk-free rate, is the interest rate on debt that is virtually free of default risk. And everyone should know what inflation is, right? The increasing price of goods, right? So these terms you should know they're somewhat important, so I'd go over them. And here's the inflation premium, right? And there's all these different premiums that get added to the real rate. All of these get added to the real rate, and they determine the nominal rate. And there's a simple equation. So here's the real rate, which is, the risk-free rate. This is the risk-free rate, RF, which is equal to the real rate plus the inflation premium. And here's the debt rate, which is the real rate plus the inflation, plus the inflation premium. Here's all the other risk premiums. So RD includes all the risk premiums, right? And these two terms again make up the risk-free rate right there. All right, so this term here, the prime rate, and banks charge to their best customers, right? The highest quality, best customers. And Moody's and Standard & Poor's, as you should know, does bond ratings, right? And they'll rate bonds, and the worse the rating, the higher the interest they have to pay because of the risk. Everyone should be aware of that, right? All right, so senior debt is debt secured by a venture's assets. Subordinated debt is debt that has an inferior claim to senior debt, right? So this comes first, this comes later. And here's the term structure of interest rates, and you'll see this with government securities. The longer out you go, the more the risk, right? Here's 20 years, so the higher the interest rate that they have to pay. All right, so here's this equation again that we all saw. And they just do a simple example, and you can see they just add things up. So there should be nothing, you should just know the 5 components here that make up the rate. All right, so investment risk is what? The probability that you're going to take a loss, and we all know investment risk, if we go into the stock market, it goes up, it goes down, right? Debt, equity, and basically including a guy like me, all assume investment risk. And everyone should know that how do we measure risk with investments? And it's the infamous, and I'll highlight this here, standard deviation, right? So I'll save that. And let's see if I can save that. Let me just save this so I highlighted that, okay. All right, so here's basically, everyone should know this is the holding period return. This is an important equation, but it's very simple. They go with a simple example. Okay, so here's holding period return, right? Cash flow, and you just add these values. And this is just a good example to follow. All right, and here's the expected rate of return. Everyone should know basically how they're doing that. It's the sum of the probabilities times the chance of getting that rate, and then you just add everything up at the end. So you multiply each term like this here, get these numbers, and then you basically, you notice if you add these up here, you'll get 20. 18 plus 8 is 26, minus 6 will give you 20. All right, and don't worry too much, but this is how you have to calculate standard deviation. You should just go over this so you know you have a general. I would put this on your sheet just in case, but I don't think I'm going to have you calculate standard deviation. All right, so the more spread out it is, the more the risk. Remember that? This has less risk because it's tight. This is more spread out. All right, so the coefficient of variation, if you have different that expected returns, you have to calculate the coefficient of variation, right, to get the risk. The higher the standard deviation and the higher the coefficient of variation, the greater the risk. Here's the equation for the coefficient of variation. Let me highlight that for you. All right. Whoop, what happened there? All right, let me do that. All right, so basically private equity investors are owners who basically are not trading in public markets, and their stock is not publicly traded, okay? So you should know what these terms are, you know, for a true and false thing, right? So closely held corporations, we'll highlight that. And publicly traded is what I do and probably what some of you do, right? Okay, so organized securities exchanges. What we basically, where a guy like me trades, it's got a trading floor. If you watch CNBC, you'll see them running around on the floor making trades. Over the counter, I talked about is like NASDAQ, right? Over the counter would be something like NASDAQ, right? NASDAQ, right? And it's they use computers, right? And it's basically electronically trades, and there's no trading floor. Okay, so how do I get the market capitalization of a company? Take the number of shares that are outstanding and multiply it by the current stock price. Simple equation, and that'll give you the market cap. And you hear them talking about that every day, like with Amazon and all these companies and Google. Okay? Well, you've seen this equation again, And here's the terms that make up cost of equity this time instead of debt. And you just use the appropriate terms here, and you'll add that up. All right, so this is the, if you remember from 330, we had it, the capital asset pricing model. And that B is everybody should know what that B is, right? That's a beta. Right? So that's beta. Here's the market rate, right? Here's the risk-free rate. All right, so the difference is called the market risk premium, and they just take the subtraction and call it the MRP, or the market risk premium. But this is the same as the other slide, except they just do the subtraction here, and they call that the market risk premium. All right, and here's the return on a new venture, and there's a thing called venture hubris, right, which is the HPP here. So again, there's just a bunch of terms, and you know, you basically add these up, and this is for a new venture, right? Basically, you have hubris and thinking it's going to really do well, which you should, right? All right, so here's different target return comparisons. Not much to worry about there. All right, the weighted average cost of capital is real important, and what you should do is figure out, you take the debt rate and the debt to value and the equity rate, multiply that by 1 minus debt to value, and minus 1 minus the tax rate. And you should go over this equation in your book. It's like real important. And okay, this is called the weighted average cost of capital. So just go in the book and figure out how to do that. I think there may be, here's an example here of that. So this example is worth going over. Whoops, sorry about that. All right, so this ain't too important to worry about too much here. They're just showing it to you graphically. We're not going to go over EVA, so I wouldn't worry about EVA. All right, and so don't worry about EVA. So that's about it for this Chapter 7.